All right. Today is Sunday, September 8th. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. And I hope everybody had a great weekend and you're rested, relaxed, because you might want to be prepared to be slapped in the face yet again. Because boy, this week was rough. Ooh, oh, what a beating we got. We talked about ugly September, and it was ugly so far. How ugly was it, Maverick? The S&P 500 lost $2.2 trillion in market cap in 1 week. Poof, gone. Oh, it was an ugly week. How ugly was it, Maverick? NVIDIA lost over $280 billion worth of value in a single week. The largest in U.S. history. Poof, gone. In Fortune magazine here, they say it's because of antitrust police and all of that bullshit. It's not because of antitrust. It's because the bubble is bursting right now. More on that in a minute, but, was it really, we talked about this before, folks. It was obvious. We gave you a video, I think a couple of weeks ago with the Soros in the thumbnail, and I said it's obvious when you got Soros, Jensen Huang, and Drunken Miller, and Polo Management, and Buffett, and everybody dumping these stocks. The message was not clear. They're stupid, you're smart, they sell, you're gonna buy because you think you're smarter than them? Come on. It's the first time in history where the oligarchy actually tell us, hey folks, party's over. Might want to get out of it right now. And what do? We say, you know what? Thanks so much for the advice, but we're gonna buy the dip. Because you guys don't know anything about the stock market, we do. Now, fortunately for the oligarchy, you need dummies to exit the stock market and cash out. Because when you sell, somebody has to buy. And they send their dogs on the media, CNBC, Wall Street Journal, all over the place to keep telling you to buy the dip over and over and over again so they can sell over and over and over again. Right before the top in NVIDIA, they came out with the insane lifting of NVIDIA's stock price target. It was a competition. Oh, it's going to go another 21% from here, another 50, another 100 from here. And right then and there, it was the top. And then, of course, came the banksters again, Goldman Sachs, Bank of America, all of them. Buy the dip in NVIDIA. We still got another $120 trillion to make. And of course, the retail traders bought hand over fist in droves, and they're not working so far. All of that stock splitting, by the way, that they gave you, and we told you in this channel, that's a trap. They don't split a stock until they're ready to dump. It's actually a trick to allow them to dump more, because they need buyers, and the price is way too high. If they're going to dump, who's going to be a buyer when the price is way too high and inaccessible to the public? They have to split the stock so they can get you in. You'll be the buyer, they'll be the seller. They cash out, and you get trapped. Welcome to the stock market, baby. It's a Ponzi scheme at the end. If you know how to play it, though, you'll make a lot of money. Unfortunately, most folks don't know how to play it, but we're trying to help you out here. Only if you listen, the rest, they'll do whatever they do, whatever they've been doing. In every bubble before, nothing's gonna change. Anyhow, folks, let's begin the discussion tonight by a visit to the Wall of Hope, because a lot of things are changing as we speak. Let's begin with the monetary policy, of course, the hopes for rate cuts. When we talk about rate cuts, we have to talk about the dilemma of the cakes. So the market loves having options, the fantasy. The market loves and thrives when it's living in a fantasy. And so far, the fantasy is having 2 cakes, and you can eat them too. And with Ozempic, you're not going to gain weight. It's a win-win, baby. But cake number 1 says, you know what? All of this recession scares that we have, that's not real. And we don't want the rate cuts. All of that jerking off that we've been doing for over a year now, based on the premise that the Federal Reserve will cut rates at some point, all of a sudden the market doesn't want it anymore. And if the market gets any piece of data, any fugazi piece of data, a jobs report that is cooked, or GDP, or retail sales data that is cooked, it says, you see, we don't need the rate cuts. The economy's doing fine. We're not in a recession. And if we get a bad piece of data, and maybe we have a recession risk at least, you know what? The Fed is going to take care of it. The Fed is going to cut rates aggressively, and that's not going to be a threat anymore. And the market loved this dynamic. But as we get more and more data, and we talked about this in past episodes, that one of these cakes will disappear. And we all know which one will it be. It's cake number 1. No rate cuts because there is no recession. At some point, the data will keep rolling in. And we will get more and more recession indicators. At some point, we're going to have to succumb to the reality that the recession is looming. And any hope that the economy is holding, and it's going to avert a recession, all of these hopes will disappear. I mean, you think about the data that we got, the reason why we got a huge fit this week. It begins with, of course, the September phenomenon, when you have all of the funds programming their algos to hedge right away because we have an ugly September. Usually September is not good seasonally for the stock market. So when all of them hedge at the same time, what do you think happens to the VIX? What do you think happens to the stock market? We dump. And if there is no buyer of that dump, then the stock market keeps going down and down and down, as we've seen this week. It began with an ugly Monday because the hedging was happening pre-market. The algos were already programmed. Of course, at the end of the month of August, Friday, they closed positive so they can cash in the bonuses. What they didn't tell you, though, is they're already programmed the algos to dump the moment September begins. Okay, so we got a dump. Will the buyers show up? The buyers need a reason. And we didn't get any good reason for the buyers to hop back in. If you think about the data that we got throughout the week, it was recession, recession, recession. Warning sign after warning sign after warning sign. It began with the manufacturing PMI. And a reminder, the chief economist Chris Williamson, this was the most important piece of the commentary. Quoting now, the combination of falling orders and rising inventory sends the gloomiest forward indication of production trends seen for 1.5 years, one of the most worrying signals witnessed since the global financial crisis. Oops, now we got a problem. Now we have a shock. And the market throws a fit. Now we're waiting for any piece of data that comes out and give us hope that the economy is not in a recession. Sure, maybe we have a weak manufacturing sector, but it's not the economy. Manufacturing is what, 10-20% of the economy? So the market held on because we had two pieces of data that we were waiting for. The services PMI, and then after that, the most important piece of data for the week, the payrolls. Now, when the services PMI came out, the media dubbed it as good news. The services sector is actually doing pretty good. It's in growth territory. And it pours water on any recession fears that we got from the manufacturing PMI. But I explained to you in the program that I have my problems with the services PMI. Sure, the headline reading is above 50, but it's stalling. And it's only a tick above 50. But then you look at other categories. You got employment down 0.9 of a point month on month. Inventories up 3.1. Why are inventories going higher? Well, the backlogs of orders down 6.9 points month on month. Export orders down 7.6 points month on month. But we now know why inventories are going higher, even in services. Weakness in the consumer. Orders are slowing down dramatically, and that's causing a rise in inventories. If you have a rise in inventories, what do you think happens to employment? Do you need as many employees anymore to fulfill all of these new orders that you have? Of course not. And on top of that, prices went higher by 0.3 points month on month, and the rating is way too high, 57.3. So we have a problem with sticky inflation and stagnation of economic activity, aka we have a stagflation phenomenon in the services sector now beginning to show up. Already a recession in manufacturing, but we have a stagflation phenomenon in services, and soon enough it might morph into a recession. I did not take the services PMI as good news, and I didn't think it gave the market any reason to assume that the recession risk is eliminated. And this is why the market refused to rally based on this data. Then came the employment report on Friday, and they gave us what I call the sweet and sour phenomenon. So expectations, 166,000 jobs created in the month of August. The real number, the cooked number, because they're always going to revise the number up or down, usually down. But anyways, the number that we got is 142,000. So it is below expectations. That's the sour part. But the sweet part, the unemployment rate actually went down to 4.2%. And the cooks at the Bureau, they thought by doing the sweet and sour trick that somehow the market would look at this as a positive and rally. They failed. Didn't work out. And the reason behind that is you have to look at the devil in the details. Always in the details. When you look at full-time workers, down 438,000 jobs in August. Part-time workers, up 527,000 jobs. So what we see right now in the economy, folks are getting part-time jobs, working 2-3 jobs to make ends meet. Is this really the definition of a good economy? On top of that, when you look at the revisions, they're absolutely stunning. I mean, we talked about how the BLS Kitchen Bureau statistics cooked the job data and overestimated jobs by over 800,000 going back a year. And every month when we get these readings, we get the revisions for the prior readings. And most of the time, the revisions are downward. For example, Listen to this. While the August numbers were close to expectations, the previous 2 months saw substantial downward revisions. The BLS cut July's total by 25,000 jobs, while June numbers fell to 118,000 jobs, a downward revision of 61,000. Wow. So anybody looking at this, can you really believe the, 142,000 jobs that they gave us? All you know, next month, they're going to revise that number down. Did we say 142? Whoops, we actually created 99,000 jobs. Then you look at certain sectors like IT. The unemployment rate in IT is now sitting at 6%, new highs. And you know what? I say good. And soon enough, I hope the same thing will happen to these AI morons. Programming AI, and AI will take their jobs. Poetic justice, I would say. One of the worst things that ever happened to humanity is the rise of these little tech f***s that are running all over the economy with their inflated salaries, causing inflation all over the place. Or you think Facebook will pay you $400,000 a year if it wasn't the Fed stealing from the future of the country to pump up the stock market right now to the point where salaries of $800,000 a year are pretty much a drop in the bucket for a company like Meta. Doesn't matter what they pay. They just write a number to have you as a quote-unquote talent. When the movie reverses and the stock goes down, the economy heads into a recession, and AI takes over your jobs, forget about it. You'll be unemployed and you will never see these salaries again. Why do you think they're building AI? To replace you, take your job, so they don't have to pay these salaries anymore. And in a recession, in a stock market crash, every penny matters. They're going to look at these inflated salaries and fire your ass. But this is why I say a stock market crash, a recession will be one of the greatest things that ever happened in the history of humanity. Because these little tech f***s, they're one of the worst things that ever happened to humanity. Anyhow, that's a little bit of a tech hate for you, but with all of what's going on in the economy right now, you got propaganda minister Janet Yellen. If you're afraid about the economy, all of this talk scared you. Rest assured, you got propaganda minister Janet Yellen. She says the U.S. economy remains solid on path of soft landing with no meaningful layoffs. Need I remind you that this is the same transitory Yellen? When she said that inflation is transitory, now she says recession is not going to happen. Then after the recession happens, she says, whoops, I was wrong. If propaganda minister Yellen was right, and there is no risk of recession, then why are you increasing the supply of bonds as if we are in a recession? You lying penguin. Oh, we know why. She's trying to give the economy and the market manipulation via sugar high right before the elections. And she doesn't care how much debt that's going to rack in the books of this country or what the impact is going to be when you exhaust the ammo to rescue the economy before the recession. Would you have any ammo left when the recession actually hits? And oh, by the way, all of the manipulation that Janet Yellen been doing of increasing the issuance of treasuries in the short end of the yield curve, the 2-year, for example, instead of issuing at the long end, at the 10 to the 30, where she can get a higher interest rate. All of this was done to manipulate the stock market higher before the elections. And I told you folks in this program, poetic justice. It's going to blow up in their faces right before the elections, despite all of the manipulation. But the problem with this manipulation that Janet Yellen has been doing is maybe it distorted the true nature of inflation, because maybe the yield curve has already been uninverted, steepening out of inversion, which is usually a sign that the recession has begun. But she delayed that signal by manipulating the issuance of bonds. And now the Fed got the signal maybe a little too late. Keep that in mind. Now, are we saying that the economy right now is in a bad shape as it was back in 2007? Not really. There are similarities. The rate cuts in September 07, rate cuts happening September 2024. We got the risk of a recession. We got a risk of a recession right now. We got back then an inflation problem. We have an inflation problem right now. So there are similarities. But again, in the August 2007 jobs report, we actually lost 4,000 jobs. We're not seeing that right now. The inflation rate went down 0.4%. You can look at it from different perspectives. For example, one way you can read this data as back in 07, the recession risk was much higher. The economy was already perhaps in a recession, and now we know that it was in a recession as early as 2007. You can also look at it as maybe in 2007 we were doing a little better when it comes to the inflation risk. Because right now we don't have a negative reading in inflation as we got back in '07. And we all know that even with the negative reading in inflation, when the Fed decided to cut rates to remedy the recession risk back in '07, we all remember, or maybe not all, but some of us remember, that the inflation risk was reintroduced. And we've seen crude oil prices rallying significantly higher by more than 75% from the point when the Fed initiated the rate cuts all the way to the peak. And then they had to scramble and pause the rate cuts and all of that. That kind of chaos blew up everything. So just keep that in mind, that yes, there are similarities between now and '07. There are differences too. The economy is doing a lot better than it did back at the same point in '07. But we have unique risks right now. From the higher debt, the risk of inflation, much stronger than back when it was in '07. We have multiple bubbles happening at the same time, from housing to AI to cryptos. And we don't know what the impact will be when you have a recession bomb plus blowing up multiple bubbles at the same time. In any case, let's go back to the cakes. So we know that the market did not get any hope that we have a good piece of data. Because you got to remember, we're now in good news equals good news, bad news equals bad news. So we didn't get any good news to say that we don't have a risk of recession. Okay, so if we have risk of recession, the market goes down. The market doesn't like it. But the market looks for the other source of hope. Will the Fed cut rates aggressively? And the problem is, on Friday when we got the jobs report, things really got ugly. When the Fed zombies came out, it began with Williams from New York, and they didn't really specify 50 basis points. The market was looking for 50 basis points. Williams didn't say it. Then came Zombie Goolsby from Chicago, and he was interviewed on CNBC by Steve Leisman, who tried over and over and over again, say it, say 50. And Goolsby would not take the bait. He said, yeah, maybe we'll do this, we'll do that, but he didn't say 50 because he was afraid of Jerome Powell. Powell didn't give the green light yet for 50. And again, a reminder, this guy is the most dovish Fed zombie of them all. So if he didn't say 50, then that's not good news. He's the most dovish because he's working for the banksters within the Fed. You got to remember that he got his job via corruption. His wife was sick of him sitting at the couch drinking beer all day long. She got him a job at the Fed, and his job is to serve the banksters. So if this guy doesn't specify and says 50 basis points or 75 or whatever it needs to be done, well, the market is not going to be happy. And that was the moment immediately. You've seen the TLT reversing. It was rallying higher and bond yields were going down and the market was kind of holding. And then the TLT reversed down, bond yields came back up, and the market flushed down because they didn't say 50. And that's what the market was looking for. Matter of fact, Business Insider says the U.S. recession could hit by election time unless there are aggressive interest rate cuts. Analyst says, well, gee, what happened to the soft landing and the greatest economy ever and the bull market and all of that? Now they're begging for rate cuts, not just one rate cut or two rate cuts, because the 50 is going to become 75 really soon as more and more bad data shows up. And that's the problem when you eliminate cake number one. Cake number two is not solid because sure, now we're looking at 50. What if we don't get 50 though? What if we get 25? And even if we get 50, more and more bad data will roll in. And we know that it takes a long time before interest rate cuts show up in the economy. When the Fed cuts rates by 25 basis points or 50 basis points, what is that going to do to the debt that you've already accumulated in your credit card? You think that the banksters going to lower the interest rate to help you out right away? Of course not. The damage is already done. What cutting interest rates actually do shows up first before your credit card and auto loans and all of that. It shows up in commodities inflation. You cut rates. That's a green light for commodities traders to buy. You cut rates, that shows up in the mortgage rates right away, and you could revive inflation in the housing market. Prices are already at all-time highs. And that's going to lead us to two problems. Problem number one is the obvious. As more and more recession data rolls in, the market will be not satisfied by 25, but 50. And then not satisfied by 50, but it wants 75 now. And then it wants a full basis point. It's going to be an ugly pursuit where the market is never satisfied. And worse, if we have any problem just like 2007 where inflation comes back because of the rate cuts, oh boy, now the Fed can't. Even if the market wants 75 or 100 basis points or more, the Fed can't satisfy the market needs. And it could get really ugly. But one step at a time, folks. Back to the wall of hope. We have another element that got damaged this week, which is the AI mania. You look at the reactions from AI leading stocks, chip stocks like Broadcom. The report was good on paper, but the reaction of the stock was down over 10% on Friday. Why? Because the market is looking forward, and the market looks forward and sees peak. The good days are behind us. From this point on, growth will be limited. It's going to shrink based on the law of large numbers alone. Not to mention, of course, if you have a recession. So we go back to the headline from Fortune magazine. They say that NVIDIA lost $280 billion because of antitrust police. Bullshit. Because NVIDIA came out in the middle of the week and said, yeah, we didn't get any subpoena by the DOJ. And they got their dog, Jim Cramer and CNBC to do it. He came out with breaking news. And the market actually sold more after he came out with the breaking news. NVIDIA sold more. Because this was not the problem. The problem is liquidation of these over-owned assets when you have peak AI, you have recession fears, and you have a seasonal phenomenon. All of a sudden, the investors, the firms, are sobering up. They're going to sell you the fantasy, but they're sobering up, and they're booking profits, and that's why NVIDIA stock keeps going down. But you know what else is a part of the demise in the stock of NVIDIA and the rest of them? I think this whole AI bullshit is being exposed right now. Because we hyped, I don't know how many trillions of dollars into valuations, $30 trillion based on the AI premise. What did it deliver so far? Oh, you can Google stuff for me and give me the wrong answer? Oh, wow. My mind is blown. Or it could count to 10? Then 50 and take a breath like a wow. That's worth what, 5 trillion right there? Come on. You know, I was watching 2001 Space Odyssey, the movie, one of the greatest movies of all time. You gotta be smart to appreciate that movie though. It's not for everybody because a lot of people are dumb these days. But the villain of the movie is Hal, the AI robot. And it kind of dawned on me that the movie was made back in the 60s. And back then, they were imagining that we're going to have AI robots in space in 2001. So I would say we're about, 23 years late? We should have produced this garbage a long time ago. But maybe the silver lining is we did not. Because that Hal motherfucker is one of the scariest villains of all time. See, you think about AI villains with the Terminator, right? Scary robot with a shotgun and a leather jacket. But when I think about the AI villains and how AI is going to end humanity, I think of AI having a cocky British accent with ice-cold veins as it nukes all of us. Because AI reflects the personality of whoever is developing this AI. And you think these folks who are developing AI right now, those egotistic maniacs, you think they're good people? Think again, buddy. Anyhow, when we talk about NVIDIA, what happened this week, it is fairly simple, folks. We showed you this last week. When you look at the year-on-year revenue growth in NVIDIA, it peaked in Q4 23, 265% year-on-year growth. Impressive, but after that, you're going to run into the law of large numbers. In the latest quarter, we got a growth rate of 122% year-on-year. Again, impressive, but it's way below 265. If you look at next quarter's estimate, the revenue growth will be down to 88%. And that's under the good scenario. Okay, let's play with that. Let's say that the growth in revenue will be about 88%. Then the fair price of NVIDIA, if we take it year-on-year, should be in or around, let's say, $95 a share. Now, introduce the risk of recession, canceling of orders, delays in supply, whatever reason it is. Would the growth rate go down to 70%? Then the price will go lower. Would it go down in a full-blown recession scenario back to 50 or 40 or whatever? I doubt it. I think that's going to happen later on. And at some point, we will see negative revenue growth year on year once you run into the large numbers from this year, especially if we have a recession and weakening economy, reduced orders, and all of this hoarding of NVIDIA AI chips. When the stocks and the valuation of these companies hoarding these chips go down, what do you think they're going to do? They're going to dump all of that supply into the market. And that's going to cause an oversupply phenomenon that reduces the price of these chips. And that's going to hurt NVIDIA even more. But we're going to run into that, maybe not next quarter, but next year, max. But the bottom line is, the peak is behind us. It is pretty much impossible to replicate a growth rate of over 265% year on year. Not going to happen. And folks, be honest with you, in every bubble that we've seen in human history before, when you get to the point of, oh, here's the next NVIDIA, the next Cisco, the next whatever the fuck, usually that's the warning sign that we've already peaked or near peaking. You know what the next NVIDIA though? It's OnlyFans. I mean, look at these numbers right here. Look at this growth. Unbelievable. $6.6 billion in revenue. You freaks spend over $6 billion to jerk off to some girl's dirty feet pictures online. Then when I ask you for $10 to be a member in this channel so we can avoid begging the oligarchy and the advertisers' money, we can be independent. Oh, no. That's too much. But you're spending $6 billion in OnlyFans? You're not even getting close to getting the real thing. What a shame. What the hell happened to men? That's my question. What the hell happened to masculinity? Oh yeah, They're all busy jerking off to OnlyFans, sitting at home, busy with their tech and AI and all of that. And then they wonder why my body's not producing enough testosterone. You have to shoot yourself with external testosterone now. And all of a sudden, everybody's surprised that their balls are shrinking in size and they got no fertility left. And oh, by the way, you're shooting testosterone and you're busy at the gym lifting weights, or some skinny waiter banging your woman. What's the point of having big muscles if you can't have balls? That's what's really important. And gentlemen, it's a cause and effect kind of thing. I'm no medical expert, but I'm going to tell you the reality about this whole thing. Because the medical experts, they're never going to tell you the truth. They want you to spend all of these thousands of dollars shooting yourself with tea, meanwhile your balls are dying. It's a cause and effect. Your body's smart enough. Your body can produce tea. It doesn't matter what your age is. Sure, it slows down just like everything else, but your body's fully capable of producing tea. But it's a cause and effect phenomenon. If your body's looking around and you're just sitting on the couch, eating Doritos, drinking beer, binging on bullshit, and then jerking off to OnlyFans, what do you need tea for? That's what your body's saying. I don't need to produce it. And you're working some stupid tech job with a fixed salary. You don't need any competition. You know, Facebook is hiring you just to keep the talent, quote unquote, until AI kicks your ass. There's no need for tea. Your body says you don't need it. Not gonna do it. Give your body a reason to produce it. Be competitive. Think out of the box. Create things. And for the love of God, shut down this bullshit OnlyFans that you got and go out there and take what belongs to you. And then your body will wake up. Anyways, what the hell are we talking about here? Oh yeah, the economy and the market. Forgot that this show is about the market. But anyways, we talked about the wall of hope. We're done with that now. Let's segue to the wall of worry. And we have, of course, the policy risk, the election risk, geopolitical, China, the no deal, and the Bank of Japan risk, one by one. Let's begin with the policy risk, because we have some ambiguity. We have a candidate that was one of the most unpopular vice presidents in history. She ran in the Democratic primaries back in 2020. And she was so awful she had to drop out. But somehow, now, she's the second coming of Obama. That's what your beloved media is trying to sell her as. And she will say whatever she needs to say just to win the elections. Because at the end of the day, she's not going to run the country. It's going to be the oligarchy, the Pentagon, the intelligence apparatus, you know the deal. The banksters. She's just the face. Just to sell us dummies that, yeah, we have a democracy, we have elections. Yet at the end of the day, the true rulers of the country, they never change. So with a candidate like this, leading the polls right now, how do you price in the policy risk if we're not sure what the policies are? She flip-flopped when it comes to the borders. She flip-flopped with plastic straws now. Okay, these are not economic issues, but she flip-flopped with the taxation issue. We talked about how capital gains taxes, unrealized gains taxes, at some point the market is going to freak out about these policy risks. And the market freaked out this week. Now, I don't think it was because of the policy risk. I think it's because of hedging, September phenomenon, and the economic data that we got. But just a mere pullback in the stock market, and Kamala Harris immediately flip-flops, changing her policies. Because the billionaires were kind of whispering in her ears just last week, hey, this is crazy, don't do it. We're supporting you right now. If you go the full distance with this, not going to support you anymore. So now she says, okay, the capital gains tax is 28% and that's it. And as far as the unrealized gains taxes, we're not going to talk about that anymore. Even New York Magazine says how Kamala Harris can prove she's not a flip-flopping phony. This is not me saying it. This is the New York Magazine saying it. So again, when we talk about Kamala Harris, how do we price the policy risk? How do we guarantee that this is going to be the full flip-flop? She's not going to flip-flop again later on. Then you look at the other policy risk where we see overlap, where we see bipartisan support. For example, tariffs is now becoming a popular issue in both Democrats and Republican fields. Different approaches, of course, but at the end of the day, we're going to have tariffs. Would that be good for the stock market, for inflation, for the economy? I mean, it depends whether it's a choice or not. You look at what happened with China's export of steel the moment Trump took over. We've seen China's export of steel going down. The moment he's out of office, China's export of steel went higher again. Now, I'm not in favor of tariffs. I'm in favor of an economic deal with China where we can actually regulate and agree together on the production of steel. So there is no overdumping by one side versus the other. But if there is no agreement, then tariffs are going to show up. And that's going to cause pricing to go higher. Steel is just one example. Think about lithium batteries. Think about copper. Think about the other metals that we're going to have to regulate and put tariffs on. The other products that we have to tariff. That's one policy risk That's now becoming reality from both sides, and the market has to price that in. When we talk about the policies, both of them will be hawkish when it comes to issues like steel. For example, we knew ahead of time that the Biden administration would block Japanese Nippon from buying U.S. steel, and this is an issue that both parties agree on. Be it Harris, be it Trump, doesn't matter. They're going to block it. And we've seen U.S. steel start going down once we got the announcement of blocking the deal. I agree with it. I think it's a national security issue to have one of your largest steel provider being sold to a foreign country, even if it is an ally. But this kind of defensive posture, it ain't just Democrat or Republicans. We have a consensus on that, and that's just going to amplify as years go on. Now, the stock of U.S. steel will still be volatile because we got the news that if Nippon Steel is not going to buy it, then it's going to be Cleveland-Cliffs. Again, domestic company buying U.S. steel. We'll see if that's going to happen or not. Because the other policy risk is if we have a concentration by one producer, sort of a monopoly. And perhaps in this case, it would be Democrats opposing it, not so much Republicans, but we'll see. The moral of the story, though, U.S. Steel used to be the biggest company in the world. You probably remember Hyman Roth from Godfather 2, the main villain. Your father did business with Hyman Roth. Your father respected Hyman Roth, but your father never trusted Hyman Roth. And he says this famous line in the movie.
Michael, we're bigger than U.S. Steel.
Now, if you own a 7-Eleven store, you're bigger than U.S. Steel. Matter of fact, this show is bigger than U.S. Steel. And the moral of the story is you can be the biggest company in the world one day and then you lose it and you become irrelevant. I remember when ExxonMobil was the biggest company in the world. We're not talking back in the 80s, we're talking about in the 2000s. You think NVIDIA is going to still be the biggest company in the world, or Apple, or Microsoft? They're going to lose their spot at some point. And I think in the aftermath of this upcoming economic downturn, all of these technology companies, AI companies, they're just going to become cash cows, dividend-paying stocks. And we will see the rise of new companies. Let's just not get ahead of ourselves right now and go back to the wall of worry. We got the elections risk. We talked about this before, that the polls are going to tighten. We got the new one. This is fresh out of the oven. The New York Times poll. And in this new poll, Donald Trump is actually winning by 1 point. So it is tight, but now we're seeing Donald Trump leading, pulling ahead. And the market has to price. I was pricing in Kamala Harris becoming president. Now I got to price in perhaps the odds of Donald Trump becoming president again. Which makes the upcoming debate, folks, Tuesday, 9 p.m. Eastern Time. It makes this debate highly critical and important for us, the public, to find out who's going to serve the oligarchy better. You know what the problem for the Republicans and Trump, though? You can lead in the polls, you can crush the debate, but you ain't going to win the state of Wisconsin. I think that's in the bag for the Democrats. And if you're listening from the state of Wisconsin, buckle up your seatbelts. I'm about to shed in your state a little bit here. I've never been in Wisconsin, don't know a lot about it, but I've banged a few chicks from Wisconsin. So I think I'm qualified to talk about this. And by the way, the trick is you got to talk about the Green Bay Packers, not cheddar cheese. Otherwise, they know you're stereotyping and, oh my God, another guy talking about cheese. In any case, if you look at the details of a lot of these polls, in the state of Wisconsin, believe it or not, every other state, they say that the economy is the number one issue. In the state of Wisconsin, they actually think that democracy is the number one issue. They think that decency is the number one issue.
Get the fuck out of here.
Let me just say this. We have neither. We don't have a democracy, and we don't have decency either. A, it's a republic, not a democracy. And even if it was democracy, we've lost it the moment we decided to sell it for the highest bidder. B, when you want to talk about decency, come on. Or the mean tweets, that's not decent for you, but causing the least home affordability conditions in the history of the country. That's decent for you? How about bombing thousands of kids and sponsoring the bombings of thousands of kids overseas? Oh, that's decency. Give me a break. We got no decency. We're killers. We're descendants of killers. ThickAncestry.com, when you do the DNA testing, will let you know that, oh, Grandpa actually came to this country because he killed another shepherd in Ireland. And to escape justice, he came over here. ThickAncestry.com will show you that. Of course not. But anyways, oh, by the way, I don't know if you caught this, but Putin, he now endorsed Kamala Harris in 24. So we'll see if that's going to sway Wisconsin or not. But I think Wisconsin is in the bag for the Democrats. The rest still in play, but if you're going to lose Wisconsin, you got to win at least one of these Midwestern states. Pennsylvania, you got Michigan, but you got to do one of those. So if it's not Michigan, maybe Pennsylvania. If you lose all of them, forget about it. You can win Arizona, Georgia, North Carolina, Nevada. It wouldn't really matter. Anyhow, back to the wall of worry. We have the geopolitical risk, which was not front and center this week. Of course, we got to keep an eye on the Red Sea issue because it might not be relevant right now, but it will. We talk about the revival of inflation risk. I mean, here's the headline from Bloomberg, and it reads, America is losing the battle of the Red Sea. We spent, $5 million per shot. We blew up about over $1.5 billion of expensive fireworks. Yet the Houthis with flip-flops are still bombing ships and blocking the Red Sea. What is that causing to shipping rates and insurance? Well, that keeps going higher. And whether you have Fed rate cuts or no rate cuts, recession, no recession, that is an inflation dynamic that will still be with us. And if we're talking about we need 50 basis points cuts or 100 basis points cuts, any tick higher in inflation will be problematic. I know a lot of folks are not right now paying any attention to the inflation risk, and I get it. It's because the recession risk is more dominant, but the inflation risk will make a comeback, I promise you. Anyhow, we go back to the wall of worry. We got China. We talked about the stagnation of the Chinese economy in previous episodes in details. The problem with the stagnation of the Chinese economy, it's the factory of the world. It's the largest consumer in the world. And if you have the Chinese economy paralyzed, as Barron's put it, the world will pay. I mean, think about the growth that we've enjoyed as U.S. companies and McDonald's and Tesla and Apple for years now. We're not going to enjoy that anymore. How do we replace the enormous source of growth from China when it disappears? Not to mention, of course, the geopolitical issues that at some point we got to forego all of this economic reliance on China. China is, at the end of the day, a foe, a competitor. And then you look at the European economy. Now, Europe has a much weaker economy than the United States, and they rely on China to make money. The problem is, because of NATO, all of these European states are just cucks for the United States, and they follow what we order them to do. But at some point, as the recession begins to roll in globally, wouldn't you think that these countries will begin to look for their national and economic interest and raise the mid-finger to the United States? That enough is enough? You're hurting us right now. It ain't gonna hurt you. You have all other sources of growth, but it's hurting us. So we see right now ASML, a Dutch company, that we're banning from exporting sensitive equipment to China. Matter of fact, they say that the U.S. desire to restrict exports to China is economically motivated. And it's motivated to protect the U.S. supremacy in producing AI chips. Europeans don't really care. They're not in that race anymore. But they want to sell stuff to China to make money. I mean, you think about the German economy and the horrific data that we keep getting from the German economy. They need to export more and more to China. Well, if China's economy is weak, that's one whammy. And if the United States, with its 40,000 troops in Germany, by the way, you wonder why Germany is obedient? Anyways, but if the U.S. keeps telling Germany not to export their stuff to China, that's a double whammy. And it's going to get really bad for Germany. The only thing that is holding the German economy from becoming a third world country right now is the fact that they're tied to the U.S. market. You look at the German DAX in candlesticks, you look at Dow Jones in white. It's going hand in hand. If the German stock market was actually reflecting the truth and the reality of the German economy, it'd be down 50, 60, 70% right now. But because of the U.S. market holding right now, we see the German economy still holding. Despite all of this, again, horrific economic data. What do you think will happen when the U.S. stock market crashes? Well, Germany's going to be in massive trouble. Even douchebag CEO says that he urges Germans to work harder to pull the country out of its economic lull. Maybe he should work harder. But again, the banksters have no respect at all to regular folks. But the bottom line is, folks, I think when we see the economic recession and the crash hitting the U.S. economy, European economies will be a disaster. And we're going to see this split that if they want to get out of their horrific economic situation, they got to do business with China. They got to import cheap gas from Russia. And this is why I think that NATO is going to break from within after this recession, because the Europeans are not going to take it anymore. And that's going to be another element, by the way, in the wall of worry, the collapse of European economies. But we go to the wall of worry that we got right now, and the next element we have to talk about is the Jerome Powell with the no deal thing, and a lot of folks think that that's not a risk anymore. But it is, in the sense of what the market wants right now. What if the market wants 50 basis points or 75? Can the Fed satisfy the market's needs? Or would the Fed say, no deal, I'll do 25, but I ain't doing 50? What would stop the Fed from doing so? Well, we got the CPI and PPI coming out this week. And like I said, a lot of folks dismiss the inflation risk. I think it will come back with aggression. Maybe not this week, but after the cuts, it will be a problem. But if this reading this week, let's say, shows a rebound in inflation, I doubt it, but hypothetically, if we get a rebound in inflation or another sticky inflation reading that limits the Fed to only 25 basis points cuts, the market will be upset. The market will throw a massive fit. And this is why I say that this week will be hard, just like we've seen last week. And the reason is the market right now in the throwing a fit mode. The market wants 50. Let's see if the data merits 50. And if it doesn't, we got a problem. So the market will keep going down until somebody from the Fed comes out and says, yeah, we'll do the 50. We'll do 75. We'll do whatever it takes. And Goolsbee didn't do it Friday. Williams didn't do it Friday. We'll see what happens this week. But again, they're not going to open their mouth until we get the CPI and PPI out of the way. Those readings will be important. And this element in the wall of worry cannot be dismissed. Now, the next element that we have is the Japanese yen and the Bank of Japan. This could flare up really soon, as soon as overnight. I gave you the danger zone when we look at the JPY versus the USD. And we're above the danger zone, aka when the market becomes bearish. And we're now challenging the highs in the Japanese yen versus the dollar from last month in August when we've seen the massive crash. If we go above these highs, then you will see the risk of margin calls in the technology companies, the Amazons, the Metas, the Apples, the Teslas, the Nvidias of the world. You'll see margin calls on those, and we will see more and more liquidations. So buckle up your seat belts, folks, because this could be rough here without a savior of some sort. You got the hedging phenomenon because of the seasonality of September. You got the weak economic data indicating a recession. You got the election risk coming out with the debate this week. And on top of that, you got the mechanical risk of the Japanese yen moving higher, causing margin calls. And if all of these elements flare up at the same time, we could see the VIX at 60 again, and the market will flush down in a big way. So buckle up your seat belts. It's going to be an interesting week. Let's talk about our strategy here for the market, because we talked numerous times before. To win, this is the quote from the great movie, The Color of Money. To win, you need brains and you need balls. And if you have too much balls, little brains, not going to work out. And the same can be said if you have too much brains, little balls. You're going to miss out on trading opportunities and a lot of other opportunities in the market. And this is why we use both. And this week, the number one complaint by, let's say, bearish investors. I missed the drop on Monday. It happened right off the gate, and the market right now is oversold. I'm afraid to open a short position right now, to take a put options trade right now, because the market got oversold on the hourly chart or the 2 hours chart or the 15 minutes chart, and it might rebound. And next thing you know, the market keeps going down, and oversold becomes even more oversold. So you got to use brains and balls at the same time. Use brains as we did before the payrolls. We presented the bullish case and the bearish case. Which one has better weight? In the bullish case, we said the momentum indicators, the RSIs are oversold, the MACDs are rolling from bearish to bullish. There is a chance that we could see a correction from bearish to bullish on the shorter time frames. And of course, cooking the data before the elections. What if the report comes out better? And what if we have a big cap rotation? You got to remember, Thursday's session, the big caps outperformed the value stocks, the dividend-paying stocks. So there was a little bit of risk that a rotation could ensue if we get a good jobs report. What about the bearish case? All of this is before the payrolls, by the way. Daily, weekly charts remain bearish. The VIX is still above 20. There's a change in market character. Every time we've seen a drop before, the dip buyers came in droves. We didn't see that Monday, Tuesday, Wednesday. The buyers didn't show up. And every time a company said AI, their stocks blasted higher. This time companies can say AI 100 million times, and the stocks will go down. Look at AVGO, for example. Which case had better weight? Obviously, the bearish case. So we said the strategy is you got to have some bearish trades with October, November expiration. That's your main trade. And then complement your bearish trades with bullish trades for the week as a hedge. If the payrolls come out decent and we see the market going higher, your bullish trades will pay off for the losses in your bearish trades, and then you can reassess, do I keep these positions or not? But the worst thing you can do is be too afraid and too wrapped up in your head, where you have too much brains but too little balls. And then I gave you, of course, all of the indicators on my Discord. Again, stop paying for OnlyFans. Pay for the Maverick of Wall Street instead, so you can pay for more OnlyFans later on. But we gave you this from the get-go, that confirmation is short in the Nasdaq futures once we lose 18,825.75, got the confirmation to do it. If you did it Friday, it was a nice, decent payday. Now, what do we do this upcoming week? We talked about throwing the fit, that now the market is looking for 50. Nobody's going to come out and say 50 until the CPI and the PPI is out of the way. So again, it could be a fit all the way until that happens. So what do we do with the strategy that we got here? Being long value, dividend-paying stocks, value mid-caps, risk-off rotation like utilities, in staples and gold. When you look at the performance for the week for these assets, all of them were down for the most part. So there was no corner of the market that actually worked out. Very little stocks here and there that did perform for the week. But even these value dividend-paying stocks, risk-off rotation, none of them really worked out. And this is why we say the strategy right now, you can stay long, but you got to have a hedging strategy on these assets, which is a collar strategy. And I did recommend doing that last week. You can sell a covered calls to finance some puts, and that way, if these assets go down, your puts will be the insurance policy. If they go down in a big way, in a flush down, you're going to preserve the right to sell at a desirable price. So we're going to stick with that strategy right now. What about the rent category? Oil, copper, small caps, regional banks, the risk-on rotation. You got to remember, some of them actually did pretty good on Friday, like the profitless companies, GameStop, AMC, so there's a meme phenomenon happening too. The cyclicals did a little better this week, but also got hit hard. By the end of it, none of them really survived. I think in a throwing the fit mode, you don't want to be renting these assets. I think we should be out of it. Maybe after the cuts, after we get a confirmation, let's say, that we're going to do 50, let's see the reaction of these assets. We might see a revival of the light at the end of the tunnel phenomenon when we see the small caps and the profitless companies moving higher. Oil, copper, because of the rate cut. But between now and then, I think they're going to be under pressure too, so we're not renting those anymore until the cuts are already in and we see a positive reaction. We want to concentrate more on the sell/the short side. Again, if you sold or shorted the big caps or the chips, you did pretty good. We did this strategy a few weeks ago. It's been working out pretty good. I think the opportunity right now in the market is in short, meaning that you're not buying put options, but you're actually shorting certain securities because we do have tops that already formed. And I'm actually beginning to short these assets. So we talked about Super Micro, for example. We shorted that back in February. Look at the crash that happened in this stock. Now, I've been talking about it, folks, for a while. I said that this is going to be the comeback of the dot-com bubble. It's going to crash before everything else, and it's going to be the leading indicator. Nobody wanted to listen back then. You missed on the short when I was talking about it. Okay, do we have any other asset that we can short? I mean, look at this beautiful head and shoulder pattern in the SMH, the semiconductor ETF, on the weekly chart. That could be the next one to go down. As NVIDIA peaks, as we see the market doing a hot tour on the AI mania, it might not be hot anymore. And we see the topping head and shoulder playing out. I mean, you look at other speculative assets like ANF, Abercrombie and Fitch. That appears to be breaking down too. You look at another one here, Elf Beauty in a bubble, and we talked about the top of this stock a few months ago. Now you see it breaking down with a double top, breaking trend for the week. And you look at a stock like GoDaddy, GDDY, weekly chart. Been an insane mania, just accumulation. So you look at the AI mania, sure, that's one side, that's what everybody's looking at. But we've also seen certain stocks that just keep going higher and they don't seem to come down. And now we finally see them breaking down, and the reason is portfolio managers are beginning to review and reconsider their positioning. So we see a stock like this going down big. You look at even a decent company like Eli Lilly, but it's been in an Ozempic bubble, now forming perhaps a double top. Maybe the peak is behind us and down we go. You look at a stock like Wingstop, perhaps topping in a shoulder, down we go. So these are the kind of stocks that I'm concentrating on. Some I've been shorting, some I'm initiating new shorts, and I think that's where we're going to see the opportunity right now. We might have some long opportunities too, but after the cuts happen, we might see commodities moving higher. We might see some risk-on elements moving higher, but we got to see how the market is going to digest the first rate cut, and then consider from that point on, what are we going to buy and position ourselves in the long side. But I think right now, the short portfolio is the one I'm more active in. Anyhow, we'll talk about this a lot more throughout the week. But let's add more color to this conversation, folks, by visiting the market activities for the week. We begin with the closing of the indices on Friday. And here we go. The diamonds down by 410.34 points, or a loss of 1.01%. And the Nasdaq, the laggard of the day, once again in the red by 436.83 points, or a loss of 2.55%. The Spider also in the red, down by 94.99 points, or a loss of 1.73%. Even the Russell 2000 did not escape. It was down in the red by 4.03 points, or a loss of 1.90%. It was a rotation to the dumpster on Friday. Nothing really worked out. You look at the sectors, all down. Even the dividend-paying stocks, real estate, defensives, healthcare, utilities, although they're outperforming comm services, cyclicals, and technology, where we see the majority of the outflows coming from. We contrast this with the performance for the week. We can see that 3 dividend-paying sectors managed to close in the green. Not by a lot, but it counts. You got defensives, aka staples, you got real estate, you got utilities. Laggards, once again, technology, energy, metals, anything cyclical, anything where we see the outflows coming from technology, of course. The Nvidias of the world, those got hammered dramatically this week. When we look at the breadth on Friday, absolutely ugly. The NYSE, 17% advancing versus 82% declining. And the Nasdaq, 21% advancing versus 77% declining. And check out the new 52-week lows, 171 versus only 22 new 52-week highs. Looking at the heat map for Friday, ugly, ugly, ugly. Only few stocks managed to close in the green. You have some of the medical devices, some of the healthcare stocks managed to do okay. Not by a lot, though. You got AT&T, the outperformer for the day. Dollar General, of course, with an oversold bounce. McDonald's, maybe a resource of safety right now, but it was a massacre to say the least. When you see some of these drops, absolutely stunning. Even financials, which was working throughout the week, not working anymore. Yeah, you look at drops of over 8% in Tesla, over 4% in Google, over 4% in Nvidia, 10% in Broadcom. And you begin to appreciate the drop that we got on Friday. When we contrast this with the heat map for the week, a little better, because sure, we got the big caps down big, although Amazon was sort of the outperformer, down about half a percentage point. But you look at Nvidia down about 12.5%, you look at Google down about 7%, even if you look at the Ozempic, Mania, Eli Lilly, NVO, all down. Financials gave up this week. If you look at anything cyclical, because of the recession fears, in energy, in metals, absolute massacre. Even the industrials gave up. What are the outperformers this week? Still the dividend-paying stocks, but it ain't the ETF though. That was actually down, and this is why I'm in favor of buying individual stocks when you play dividend. You gotta be really, really picky. It's an active picking kind of market right now. So we see utilities doing okay, we see real estate, the big companies, the safer ones like American Tower, doing okay. You got the staples, the consumer defensives, Procter & Gamble, PepsiCo, Mondelez, General Mills, all those stuff that went way too high is pulling back like Coca-Cola. You got dividend-paying AT&T is the outperformer of the week. Tesla was an options phenomenon in the beginning of the week and then frizzled out by Friday. Then you have some of the value stuff in technology like Oracle, IBM, the outperformers. But Oracle has a test coming out this week when we get earnings. But besides that, folks, ugly, ugly, ugly. Although, if you look at the airliners, some of those managed to close in the green. And that's because of the speculation that maybe we'll see because of JetBlue. Maybe we'll see some M&A activities in airlines. I don't know if that's going to last or not. If we have recession fears, I doubt it's going to last. Even though there's one tailwind for airliners right now, which is the cost of jet fuel going down. When we contrast this map with the heat map for the ETFs, once again, the TLT, this is for the week. The TLT bonds were up, so we know that bond yields were down, anticipating a recession. How do you know? Because if bond yields go down for the right reasons, that the Fed is just cutting rates because inflation is cooling off, then you see some of the risk-on segments like the IWM, small caps outperforming. You see the XRT retail outperforming. You see biotech, XBI outperforming. You see regional banks, KRE doing pretty good. None of these did pretty good this week. They got clobbered. But you see the defensive, risk-off, yield-sensitive assets such as the XLP staples, utilities, XLU, IYR real estate, the XLV healthcare, although it was down in contrast to the rest, and the reason is the weight of Eli Lilly. So again, you have to be a picker when it comes to risk-off or dividend-paying stocks. In any case, ugly, ugly, ugly. International markets, mid-caps, large caps, tech, oil, everything is down. But it's notable to point out that GDX gold miners down about 6.5% for the week. But GLD gold that tracks the commodity is only down about 1% for the week. And this is why I keep saying, folks, as an investor, you want to be long the GLD, not the GDX. The gold miners will suffer too in a recession. You can trade the GDX, but if you want to own, you have to own physical gold or the GLD that tracks the commodity. And speaking of, let's do the performance of commodities on the close Friday. Ugly, ugly, ugly. Recession fears not going to bode pretty good for energy. It was an absolute massacre for crude oil, WTI, Brent, the RBOB, heating oil, although natural gas with a little bit of a rebound here, worth about 1.5%. It was also ugly for some of the strongest assets in commodities, the softs, coffee down, OJ, cotton. All of these are strong commodities, all of them were down, although cocoa closing flattish for the day. Of course, when we have recession fears, you're going to see the metals getting hammered, led by copper, palladium, platinum, silver, not as reliable as gold. Gold is the only one that holds pretty good. Meats, grains, all getting clobbered on Friday. Bloodbath. You look at the week. If you think the day was a bloodbath, the week was an absolute massacre. All commodities were pretty much down. The only thing going higher is natural gas. And since we're looking at futures here, the VIX, the fear index, was the winner of the week. Moving on to the big casino options, what do we see here? The volume been weak, not just because of September, but it's been weak since we got the Japanese yen crisis back in the month of August. Either the traders got wiped out, or they got too scared to the point where they don't want to participate anymore until things clear up a little. And right now we only see volume showing up in Nvidia, Tesla. Apple used to do over 1 million reliably in contract volume. It doesn't do that anymore. When we look at the ratios, we see more buying of puts. So the puts right now showing up in the 40s in Nvidia and Apple and Broadcom and AMD and Amazon. It indicates that maybe we're getting closer to a rebound, but it's not a signal within itself to say that abandon your puts or switch to calls or anticipate a rebound right away. It just shows you that demand is increasing in puts, and usually when it increases, we have a lot of Johnny-come-latelys coming to the game, either hedging or betting to the downside. Now, the other thing you have to look at is the IV rank. And the IV ranks are not elevated, meaning that the pricing of options right now is not really that expensive, which means that we could see more and more puts being bought. Now, if we were looking at, let's say, 55% or 50% puts on Nvidia with the IV rank at 100, I would have said comfortably that this is a sign that a rebound is coming really soon. You got to close your puts, you got to switch to calls. But because we see the put volume increasing, while the IV rank is about 42, 43, that's still way too cheap. You'll see a lot of folks buying puts in Nvidia, puts in Tesla, Apple, whatever they want to buy. Nothing is expensive right now. So we could see more downside to come. Keep that in mind. Looking at the flows on Friday, the buy flows, they're buying calls in Tesla, TLT, MicroStrategy, GameStop, bonds, US Steel, and the VIX. Not a good sign. They bought puts on Intel, Micron, Supermicro, Pinduoduo, Qs, Dow Jones, the SMH, the chip index. On the sell flows, they closed puts on Supermicro, on Intel, and Dollar General. Maybe this is why we got a rebound in Dollar General. They closed puts on the SPX, booking profits. Boeing, IWM, Snowflake, Baba, QQQ, Pinduoduo. They closed calls on the TLT and Apple, CME, the E-mini futures, Tesla, GLD. Now, you use a tool like OptionStrat when you look at the buy and sell flows to see the net flows, and that gives you an indicator whether a certain equity or certain security is bearish or bullish. For example, we'll look at Apple. We have about $25 million in bullish flows, be it closing puts or buying calls. Then on the bearish flows, be it buying puts or closing calls, we have about $43 million. So you got to be careful here with Apple. I know we have the release coming out Monday. What if that is a bust, though? Oh, we'll see Apple flushing down because usually we have buy the rumor, sell the news when it comes to Apple releases. So all eyes, I think, this week will be on Apple. If Apple goes down, it's going to drag the market in another leg down. Let's go over some of the unusual activities that we have. We begin with VLO. This is a bull call spread on a refiner. Now, the refiners got hammered this week. Any energy stock got hammered this week. But we know that the cuts are usually good for energy, for the RBOB to rebound. And right now, we might argue that we have oversold conditions in energy commodities, and somebody's anticipating a rebound here. They bought the 150 calls for the expiration date of December 20. They sold the 175 calls for the same expiration date. All in all, spending about $1.7 million. So the expectations are the VLO will be above 150, but not above 175 by December 20. That's only going to happen if we have rate cuts and we see a rebound in the gasoline RBOB. Then we have a quite unusual one here for Tesla. Somebody bought the 240 calls for the expiration date December 20, spending about $41 million. Now, with Tesla down about 8% in Friday's session, of course they're down. They lost about a quarter of the value of this trade. But maybe they know something that you and I don't. Maybe there's another robo-taxi pump coming. Who knows? They're betting on something here. It's not random or arbitrary that they blew up about $41 million in this trade. Not suggesting that you buy Tesla calls, by the way, because we'll look at the chart in a minute, and it doesn't look pretty good. Anyhow, we have GME, GameStop. Keith on Twitter, of course, tweeted something, and we have GameStop earnings coming out this week, so GameStop was actually in the green in Friday's session, believe it or not. You gotta rush to the safety of GameStop in ugly days in the stock market. And here we have somebody bought the 22.5 calls for the expiration date September 13th. So obviously this is a bet on earnings this week, and they spent about $1 million on those. And then we have EFA. This is an ETF for a lot of international equities. And we've seen huge volume in this guy. Somebody bought the 81 calls for the expiration date November 15th, spending about $1 million. Now, if you're going to go with the EFA, you're betting that we're going to see a rebound in international equities. That's not going to happen without the assurance of the Fed's 50 basis points cut first. Then we have the puts, and somebody bought NVIDIA puts 100 for the expiration date of this Friday, 9/13, spending about $1.1 million. I think that 100 is a psychological number. If you're waiting to buy NVIDIA, you're waiting for 100. If you've been short NVIDIA, you're not going to cover until, say, you hit 100. So it becomes an important psychological number here. And if we hit it, I think we will see a reaction. Of course, if we fail to rebound at 100 and we break through, oh boy, it's going to get ugly for NVIDIA. And here we have another put for Airbnb. We've seen a lot of bearish bets on Airbnb recently. Big ones. Something is going on with the company. Of course, we know that the model would go bust. It was never really tested under any recession before, and it might fall under this recession. So somebody bought the 135 puts for the expiration date September 20, spending a little over $2.5 million. Let's do the charts analysis, and we begin with the SPY, the S&P 500, an hourly chart. What do we do here? Let's begin with Friday, before the week began. If you look at the MACD, if you look at the close, it looked pretty good, as if we're ready to go higher, only to open Monday with an ugly flush down, and it didn't stop all the way till the end of the week. Now, we can look at the RSI and say, hey, it's oversold. Maybe it is showing a bear flag pattern, but we might go higher. I want to caution you from being too wrapped up with these indicators, the RSI and the MACD, because oversold can become even more oversold. So you have to verify, not just by looking at one indicator, the RSI, but you got to see the MACD indicator also moving back up and giving you some sign of life. Of course, this is the daily settings for the MACD indicator. You can use the day trading settings, and you will see that we've never really got any bullish signal in the MACD. Now, I don't like to switch back and forth. I just look at it from a confirmation perspective. But you can train your eyes to use the daily MACD settings for intraday time frames, and it works just fine. I've been doing it for years. The bottom line is, looking at the hourly chart, the downside risk is more predominant until proven otherwise. You gotta reverse some stuff on the daily chart. So let's do that. We visit the conversation from last week. You're looking at the daily chart right now for the SPY. We gave you the confirmation, the bearish confirmation, which is 554.73. You break that, you go short. And then we got another confirmation, which is the 50 days moving average. So now the question begins, we're not looking for a reversal. That's not going to happen right now. But we're looking for a point where the selling stops, because a reversal point is going to require us closing above the 50 days moving average in blue. That's a long shot right now. Not going to happen. So can we find support, say at the 100 days moving average in red, which is sitting right now at 536.58? That's a possibility. I mean, it happened before, as I'm highlighting right now. So the next support we're eyeing is 536.58, which is, by the way, if you clean up the 50 days moving average and plug in the Bollinger Bands, you'll see that the 100 days moving average is close enough to the lower Bollinger Bands. So again, we're getting close for support in the daily chart. The problem is if you look at the weekly chart for the SPX, the cash index. Some of you trade the SPX, so I like to look at it from the weekly chart perspective. You gotta remember that we talked about the James Bond phenomenon. No time to die. Once we got the flush down in the month of August, the rebound has to keep going until it makes a higher high. If it stops before or at the previous high, we got a major problem because now we have to assume that we have a double top. And we got to assume that the wave, the MACD weekly wave, might have already peaked. And we're going to move in a reversal from a bullish wave to a bearish wave in time. You see the negative divergences with the MACD indicator. You see the negative divergence in the RSI indicator. The next Fibonacci support would be about 51.50. It's not a coincidence for me that we've seen this trade that we covered in the program on Thursday. Somebody bought the 51.50 puts in the SPX. The expiration date, end of the year, December 31st. Spending a little over $20 million in those. But I want to revisit the MACD wave once again. If you look at the weekly MACD indicator, once we've crossed, not just with the MACD line, but the average in light blue, once we've crossed above the zero line, that was the birth and the confirmation of a new bullish wave. Comes the fourth quarter of last year. It appeared that we're going to lose the wave and go back to a bearish wave, but then came the save by the Fed, promising rate cuts. And we got a bounce, and the market went higher. Now what do we see here? We see a negative divergence in the wave, which indicates the peak of this wave. The next question now becomes, since we have a double top or a lower high, as you will see in the futures chart in a minute, is this correction leading toward the end of the wave and the beginning of a bearish wave? That's a huge question, because the answer, if it is yes, then the top is already in the market. And I think the top is already in. I argued for this months ago. Nobody wanted to listen. But anyways, maybe you're going to listen right now. If we're going down, then the top is already in. And the next step would be a major correction that produces, say, 10, 15, 20%. And then once we begin the bearish wave, the crash will be the next step. Looking at the E-mini futures for the S&P 500, what do we see here? With the weekly chart, we're at the support of the 20 weeks moving average. If we fall back below, we're probably going to do an inverse ABC pattern. And you got to notice here that the weekly chart for the E-mini future doesn't show a double top as the cash index shows. It actually shows a lower high. So if we go down an inverse ABC pattern, the next support would be the lower Bollinger Bands. That's in or around 5100. It's the same support range that we see 5100, 5150, doesn't matter, but it appears that everybody's now eyeing 5100, 5150 as the next support. When we look at the Qs of the Nasdaq, it's a similar look as we see in the SPY, only a little worse. And the reason is we've taken out about 60% plus worth of the rebound for the month of August. And now we're still forming a bear flag pattern. You're not going to assume that we're not going to play the bear flag pattern until we have a reversal by trading above the top of one of the breakdown candles within the pole of the flag. And that would be number 1, 453.81. And the one after that would be 461.22. Otherwise, I think that we might break down in the bear flag, and then we have 443 as the next support. If you look at the daily chart for the Qs, you go back to the conversation from last week. If we lose the 50 days moving average in blue again, that's your bearish confirmation to short. And since then, we've flushed down. Now we got a confirmation in the MACD, in the RSI, in the Vortex indicator, all pointing out the bearish momentum. Plug in the 100 days moving average in red. We lost that, so if you didn't catch the 50, losing the 100 was the other signal. But you gotta be fast when you do these trades, because we're looking for support now. And if we plug in the Bollinger Bands, we're already at the lower Bollinger Bands. So we're already at support right now. Whether that support is gonna hold or not, that's a different story. We could actually expand the Bollinger Bands to the downside. If we do, then we have to plug in the 200 days moving average in yellow, and that would be around 441.38. So my number is 443. The 200, 441.38, whatever floats your boat. When we look at the NDX weekly chart, what do we see here? No time to die. But unfortunately, or fortunately for some, the chart did die before reaching the top and trading above. So now we have a lower high phenomenon with negative divergences that we see in the MACD, the RSI, and pretty much close enough for a confirmation in the Vortex indicator. Now, you might look back at the lower high that we got in the summer of last year and say, but Maverick, it's not a big deal here. We can do a lower high and then we move higher again. Sure. What you don't want to see, though, is the MACD wave in the weekly chart turning negative. If we cross below zero, then the movie's over. And better yet, you got to clean up the chart a little bit here. You got to look at this trend line. We break below this trend line. You're going to have an inverse ABC. You're going to go to the downside again. 16,000 will be in play. And the end of the bullish wave is already behind us. The top is already in. Now we're looking for a bear market once again. And then after that, a crash. Looking at the IWM small caps, we moved the Fibonacci lines all the way to the exact top, just to be precise here. And the number becomes 212.83. We've lost that, so you got confirmation number 1. We've lost the 50 days moving average in blue, confirmation number 2. Then you got the confirmations with the MACD indicator. You see the red impressions on Instagram. You see the MACD rolling over, the RSI with negative divergence. The vortex indicator also showing a bearish confirmation. If we continue to go down in the IWM, I think that 203 would be a good support. So if you have the 200 puts, that would be sufficient. You go to 203, you got to assess the situation. You got to look at the VIX. You got to look at the data that we got, the CPI, all of that. If you're comfortable enough that we have a rebound coming, then you close the 200 puts and we see what happens next. If you're not in the trade yet, then you plug in the 100 days moving average, sitting at about 207.15 right now. If you lose that, then you can open the 200 puts if you'd like. You can open the 205 and you sell the 200, but we have a bearish trade here in the IWM if we lose the 100. And that could be all the way until throwing the fit period is over. And that's going to happen once we get any confirmation that the Fed is going to do the 50. Until then, the pain goes on. What about the dollar? The dollar is holding above 100 and let's say 534 basis points. Why do I have bear over there? If the dollar goes below, then we're going to reintroduce the risk of the Japanese yen. Dollar goes down, Japanese yen firms up. And now we got the margin call risk in the big caps. Why did the dollar go higher, though, in a rebound on Friday's session when we have recession data? You got to remember, initially it went down, but then came the Fed zombies, and they didn't say 50. Maybe they didn't say 50 because they wanted to rebound the dollar out of fear that the Japanese yen might firm up. Who knows? It did the job for now. A rebound in the dollar, not going to be good for the old man gold. So we see somewhat of a semi-bearish engulfing candle. And I think that we have a dip coming in gold. I don't think we're done here. I mean, it's holding pretty good, but I think you might get a better price before we see a rebound higher. So we have a rising wedge. I would not be surprised if gold goes down, let's say to 24.30 before it finds support. So if you don't have a position yet in gold, you can afford to wait a little more. What you got to be careful about is the GDX gold miners. So you see the underperformance by the GDX here, losing the 50 days moving average. Where can we find support? Plug in the 100, 35.81-ish. We might see another drop in gold, but we see the miners going down more. Then we get a rebound from the commodity, and we get a rebound from the 100 days moving average from the GDX. But that's going to require the Fed saying the 50. So the dollar can go down and allow gold to go higher. We will look at the SLV silver. Not my favorite, to be honest with you. I'd rather be in gold versus silver. This one is below the 50, below the 100. And the way I do it is own gold and then use the SLV silver as a hedge. So when you think that gold is going to go down because the dollar is firming up, you buy puts in the SLV. They're cheap. They're going to appreciate in value and compensate you for whatever stall or tiny little drop in gold. Because gold is holding pretty good if you own the commodity. The SLV, not my favorite here, folks. And you got a trend line. You break that trend line, you might see lower lows to come. When we look at the daily chart for crude oil, absolute massacre. We're now at my support of about 67.71-ish. Is oil oversold? I think so. But it needs the Fed rate cuts to rebound. Because right now we're under the recession mode. We're in the throwing the fit mode. Until we exit that and we get the rate cuts, I think oil will be painful. I mean, you look at the USO here, US oil. We are at a point where we've seen rebounds before at the lower Bollinger Bands. So it is oversold. It is due for a rebound. But it's not going to rebound in a sustainable way until we begin talking about the 50 basis points rate cut by the Fed. Now we'll look at the ratio of the 2-year yield versus the 10-year yield. We gave you this indicator before. This is the yield curve, by the way. When it goes down, we have steepening, not inversion. And steepening right now is not a good thing. So every time it ticks down, you plug in the NDX, the Nasdaq, and white, it keeps going down. And that was the leading indicator that you got to dismiss the rebound that we got before September began because the 2 versus the 10 was heading down. And until we find a footing in this ratio, we will continue to go down. Now, if you look at the 10-year alone, 10-year yield weekly chart, what do we have here? We have a trend line. We're now flirting with breaking this trend line. We know the rate cuts are coming. It's a matter of how much. It's not even when. We know September it is. The question now becomes how much. If it is the 50, then you look at the MACD indicator. This is the weekly MACD. When we study the waves, it tried over and over and over again to break below the 0 line, only to rebound higher. We are now firmly below the 0 line. So we know that the hiking campaign, the higher rates regime is over. And now we're looking for lower rates because of recession. How low can we go? You got the bear flag pattern. You break the trend line, plug in your Fibonacci, then we go down to 3.2. But I think that's going to require the Federal Reserve saying the 50. Because if they do 25, I think the 10 is going to rebound from the trend line. So 50 gets us all the way down to 3.2. Would that be good for the XHB home builders? Not if it is going down for a recession reason. So I'm going to stick with my trade here, the 110-100 put spread. Since we're below the 20 days moving average in white, I'm going to stick with it for now. You look at the IYR, real estate, dividend paying, flirting with the resistance at 175. But you look at the daily wave of the MACD, it wants to reverse. How can it reverse right now? Reason number 1. If the rate cuts are not as aggressive, say 25 basis points, and we see a rebound in the 10 to 30-year bond yields. Number 2, if the rate cuts initiate a rotation back to risk-on assets, be it the technology names, the big caps, the chips, the small caps, doesn't matter which one it is, but the money will come out of real estate, the top-performing sector, by the way, and chase these risk-on assets. So we have 2 scenarios where we see a pullback in real estate. What about the KRE? It is yield sensitive, regional banks, but it's more in the risk-on segment. Once it lost 55, we can no longer say that we're going to stay long or trade or rent the KRE. We have a bear flag that played out. We're now looking for support. And the next one we got is the 50 days moving average, about 54.23. Again, no rebound in the KRE until we begin talking about the 50 basis points rate cut by the Fed. It might initiate a rotation to risk assets. If the market reads it as, or the Fed is not panicking, because that might be another way to read it, by the way, that if the Fed does 50, the market might look at it as, why is the Fed doing 50? Maybe the Fed is panicking, and now the market throws another fit. But I think if I'm reading things correctly, since we're getting already oversold before the cuts, I think if we get the 50, the market might breathe a sigh of relief, which would be good for a rebound in these risk-on assets. We're talking about a rebound, not something sustainable. But you got to be careful here because the rebound can come after a lot more pain. If you look at the VIX daily chart, the volatility index, it looks as we are playing an ABC pattern. And we're not done yet. All of the momentum indicators, be it the MACD, the RSI, the Vortex, all pointing out for more gains to come in the VIX. If you look at the hourly chart, once the report came out, we're talking about the payrolls. You see the flush down in the VIX, cap and crap, only for the VIX to be bought again and trade above the bull to bear indicator, the 20 line. Above, you're bearish on the market, of course. Below, you're bullish. We're above, so we're going to stay bearish. And maybe the VIX is forming a bull flag pattern, waiting to break out in another move higher. Think about it this way. The payrolls showed that the unemployment rate is actually ticking down. We have the phenomenon of crush the VIX Fridays. If the VIX was done moving higher, it could have flushed down and stayed down on Friday's session. The fact that it came back, I think it is readying for another explosive move higher. And it could be led by this name right here, the big kahuna Apple. You look at the daily chart, not looking pretty good. You got the rising wedge, consolidation, and now maybe a bear flag pattern. You have the momentum indicators now showing bearishness. Whether you look at the MACD, you look at the RSI, the Vortex, doesn't matter which one you look at. Clean up the chart, plug in the Bollinger Bands and the 20 days moving average. We lost the 20 and we failed 2 days in a row to close above the 20 days moving average. Now we have the release coming out Monday. If that fails to close above the 20 days moving average, then we have a flush down coming in Apple. I think that's going to be the trade of the week. And I'm going to be buying puts on Apple. You look at the weekly chart. Observation number 1, lower high. And the possibility of confirmations on the momentum indicators, the MACD, the RSI for an inverse ABC breakdown. And if Apple breaks down, you got NVIDIA breaking down along with Apple, that's going to be a double whammy for markets. And here it is, the souffle Tesla. What do we do with this guy? We got a break above the 50 days moving average, which was bullish, only to do a massive bearish engulfing candle on Friday's session. We lost the 50 days moving average. Again, that's not a good sign. You plug in the 20 days moving average in the Bollinger Bands. We closed below. And furthermore, perhaps this is more important. If we look at the weekly chart, we have a rejection. At the yellow line, that's the 200 weeks moving average. And that's a massive rejection here, folks. If it plays out in an inverse ABC pattern, or Tesla's going to be way below 200 when it's all said and done, you got to close above that 200 weeks moving average to assume that we're out of the woods. And I don't think that's going to happen. Then we got NVIDIA, NVDA, daily chart, lost the 50 in blue, lost the 20 in white. You see the momentum indicators all negative. We're now at the support of the lower Bollinger Bands. Can it hold? If it doesn't, we visit the weekly chart. Observation number 1. We're below the Fibonacci support 110.09. Next support 91. All of the momentum indicators are now bearish. MACD, RSI, soon enough the vortex on the weekly charts. I say if NVIDIA fails to rebound from 100, then the obvious trade will be buying the 190 put spread, because we got Fibonacci support at about 91.12, and that might actually hold. And lastly, what about tulips? Bitcoin, weekly chart. It flushed down big and now flirting with the support of the 50 weeks moving average in blue. You lose that, you got a major problem in Bitcoin. We might see a big flush down. And if we do that, folks, if we lose the 50 weeks moving average, I'm going to be shorting MicroStrategy MSTR, weekly chart. It is yo-yoing back and forth within a massive range. If it breaks that range, I think if Bitcoin loses the 50 weeks moving average, next step for MicroStrategy is losing this range and flushing down all the way to sub 50. Why? Because right now the company is more reliant on Bitcoin than ever before, so it is more sensitive to the price. In any case, moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday the 9th, we have wholesales inventories and consumer credit. Tuesday the 10th, we have the NFIB Optimism Index for small caps. September 11th, Wednesday, a big day for the CPI, aka the CPI. And of course, the problem with the CPI, if it comes out sticky or a little hot, it might kill the 50 basis points optimism. Rate cuts, that is. But the action doesn't stop there. We have Thursday the 12th of September, with the PPI and initial jobless claims. PPI, the Producer Price Index, also important, folks, because it is a leading indicator to the CPI. And lastly, Friday the 13th doesn't have a good ring to it, right? We get the Import Price Index and the preliminary reading of consumer sentiment from the University of Michigan. Ladies and gentlemen, we have a lot to look forward to. Buckle up your seatbelts. But this was a long show, deservingly so, because we had a lot to cover. Hope you enjoyed it and you found it informative. And if you did, return the favor by pressing the like button, subscribing to the channel, leaving us a nice comment, and better yet, consider joining us as a member to access the daily show and bonus videos here on YouTube, or better yet, on Patreon, so you're not paying Google. All of the links in the description. But with that, folks, this is all I got for you for tonight. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
I don't know what you're talking about, Hal.
I know that you and Frank were planning to disconnect me, and I'm afraid that's something I cannot allow to happen.